Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. All right, now we're going to talk about making money when absolutely nothing is happening. This I have to hear.
Nice.
Kevin Matras, who is our top stock screener, top options technician here at Zacks.com, is going to tell us exactly how to do that, he says. This sounds interesting enough, but I mean, can you really make money when nothing is happening in the market?
You know, you really can, and that is one of the benefits with options. You can make money pretty much regardless of what's happening in the market. There's strategies for when the market's going up,
Right.
strategies for when the market's going down, and strategies for when the market is just simply going sideways. And that's what we're going to be talking about today.
Right.
How to make money when the stocks you are in or are looking at are pretty much doing nothing, sitting idly by.
Well, you've got my attention.
Well, what we're going to be doing is I'm going to be going over a trade of mine. I'm going to be using Amazon as an example, and the strategy is a strangle. So I'm going to get to this in just a moment. But the reason why I focused on Amazon is because I have Amazon stock. I love the company. I'm on Amazon.com all the time. I love the Kindle. Everything about Amazon I like, but it is right now in a consolidation period. I have no intention of getting out of that stock at the moment. But I still want to try to make some money while it is consolidating its recent gains. So the strategy that I had settled upon was to write a strangle, and that's what we're going to go over today.
All right. Now, strangles I've heard you talk about in the past. But I thought you were talking about, potential moves in one direction or another when you referenced that.
Right. And you're correct in remembering that. You can put on a strangle, and that is a great strategy to use if you're expecting a big move one way or the other. But you can also put on a strangle if you're expecting no move, and I'm going to explain the difference in just a moment. So check this out.
All right.
When you are looking at a strangle is when you have both a call and a put with different strike prices. Typically they are going to be both, or they have to be both, out of the money. But you're also looking at options with the same expiration dates. So you can buy a strangle, or you can sell or write a strangle. The key difference is that if you think something big is going to happen, you're going to want to buy it. If you think virtually nothing is going to happen, you're going to want to write a strangle. And since I thought Amazon really wasn't going to be doing anything for a while, I figured it was going to be range bound, I decided to write a strangle, and that was going to be my way to be able to make money as it went sideways. Now, I did this in kind of an unconventional manner, whereas I put one side of the strangle on first, and then I legged into the other side. So let me explain how we did it. Here's the trade. On June 5th, when Amazon was trading at around 85.50-ish. It had just put in a bottom at around 73 a few weeks earlier, so it came off that bottom, started to move higher. I didn't think it was going to go below that 73 area for quite some time, so I wrote an October 70 put for a premium of $385 or $385. Once again, I thought Amazon was going to keep on moving higher, so I thought it was a great trade. Not only would I make money on the stock as it went higher, but I would keep that premium that I wrote on that put. And for a very short period of time, Amazon did exactly what I thought it was going to do. It continued to move higher. And I think on July 23rd, it got as high as 94.40. What was interesting is that it was quickly turned around from 94.40, and it started to pull back down. So at that point, I decided I was going to be putting on the other leg of this strangle. So here's what I did. On August 5th, once again, Amazon was trading back at around 85-ish. I determined Amazon was probably not going to break past 90 anytime soon, so I decided to write an October 90 call, collecting a premium of $365 or $365. So once again, this was a way for me to be able to say, okay, I think Amazon is probably not going to get above 90, but I also don't think Amazon is going to go below 70. So I basically played a range, and I figured as long as the market stayed within that range, I'm going to be able to collect premium on both sides. Now, those October options are still in play. There's about 36 days left on those options. I think the Octobers expire on October 17th. So I'm going to have to wait another couple of weeks before I get my full payout on these options. But so far, if you were to look at all of the premium that I collected, that is a potential $750 payout for both options. And so far, those options right now, the total value is only $200, so about $550 worth of premium has already been stripped away. That goes straight into my pocket. But again, what I am hoping for is, if you look at this chart, I need to see Amazon stay between those two lines. It has to stay below 90 and it has to stay above 70. Now, if Amazon starts to go above 90 at expiration, only then will I have to start giving back some of the premium that I collected for writing that call in the first place. But if it did go above 90, I'm making money on the stock and I keep all the premium on the put. If at expiration Amazon goes below 70, only then will it start eating into some of the premiums that I collected on the put, but I will keep all that premium that I collected on the call. But my bet is it stays within this range between now and expiration, and this is a way for me to be able to make money while it pretty much does nothing. And what's interesting is that right now Amazon is at right around 82, 83-ish. So when I put both of these sides on in the first place, Amazon was right around 85. So if, let's say, over the course of the next few weeks, Amazon is still at 85, if you had 100 shares of Amazon, that's about $8,500. And after everything is said and done, the stock would be pretty much flat had you put a position on there. But you would have collected $750, and I think that is a very, very good rate of return while a stock is pretty much doing nothing.
So a good strategy if you think you've got a sideways moving stock here.
Yeah, if you think, and again, you don't have to be in a stock to be able to put one of these strategies on. You can literally screen for stocks to identify stocks that are in these trading ranges. And that's the beauty of a strangle. You don't even have to pick a direction. You don't have to think a stock is going to go up, or you don't have to think a stock is going to go down. Really, if you just decide, I think a stock is not going to do something, this is a pretty opportunistic strategy. And you don't even have to be specifically correct. You just have to identify a generalized range, and it's a really good way to be able to collect money while the market pretty much does zero.
Cool. When do you apply the Heimlich maneuver? It's something else. I'm sorry.
That's if a trade goes wrong.
And it happens over dinner
Yeah,
or something.
right.
Yeah. Just more information to help you know your options with Kevin Matras. I'm Terry Ruffalo.